Hi, Gonzalo. Hi, Brea. How are you doing?
Hi.
Good to
Hello.
see you. I see that there are already 39 people connected, 40. Let's give it a couple minutes just in case for people to finish connecting.
Okay.
But yeah, I always give 2 or 3 minutes to make sure that everyone is connected, and then we jump to the topic. But again, thank you very much for being on time.
Thanks to you. Are you Madrid, Jaime?
Yeah, where it finally stopped raining
I
after
was gonna
3
ask.
weeks. I can bet that you had better weather than us for for the last 3 weeks from Munich.
Ah, come on. Actually, we had a lovely week for 2 weeks, but lovely weather. Yeah. Come on, you're complaining too much. No, we have rain for 3 weeks. Come on.
Yeah, I wonder how the winter was in Munich this year.
November and December were really dark. Let's say
Yeah,
that.
too. But it's I heard as well about that is like a big thing in Germany to move to South Africa, like in Germany in the tech world to move to South Africa in the winter, right? It's like same time zone, better weather, summer there. Yeah.
Funny people I know, they move more to Spain in general, like Barcelona, Madrid, Mallorca, of course, and but even Andalusia and everything during the winter period, and then they go back.
I see.
Yeah.
Makes sense. Makes sense.
Yeah,
Absolutely.
of course. They rent the houses, which is very common to rent. Imagine, which is not that common in Spain, but you will rent the house for 6 months. If
Mhm.
you're out your house, you will rent it out for 6 months, and then you will come back and you will get it back. Super common in here to do that.
I see. No, that makes sense. I mean, if you can like sublet your own home and then like rent one with better weather, I guess there's no problem. Perfect. So yeah, I think we can get started. I think like it's already 5:32. So I would say let's get going. So well, first of all, again, Brea and Gonzalo for connecting and for participating in the webinar. And thank you very much to all of the participants to connect on time as well. So, well, first of all, I'll introduce myself. I'm Jaime. I'm the managing partner of the Startup CFO. In the Startup CFO, we offer fractional CFO services for startups in early stage. We offer from the admin work to the added value CFO role. We help, obviously, in strategy, fundraising, KPIs, reporting, forecasting, and this type of services. And we have our headquarters in Spain, in Madrid, that you probably like recognize my accent, besides also Gonzalo said it before. And but we also have an office in Berlin. So we serve companies both in Madrid and in Germany. We're a team of 38, and we started the company in 2020. So we are, and I think we always have tried to be pretty strong in content. We also have an initiative that, in fact, the last edition is just starting, that is the Startup Academy, that we offer our knowledge in startup finance that we have acquired during these years working with almost 400 startups, I think. And we have many public webinars, we have a YouTube channel. So in general, we try to be pretty strong and pretty active on what we consider that it's our field, which is finance in startups. And part of this initiative is of course, this webinar. So we are gonna focus like we have a German startup, we have a Germany, well, an investor in Germany, in Gonzalo. We're gonna focus partly there in the market, but we're also gonna talk in general, because these trends tend to be pretty global, about fundraising in the recent time, fundraising in the near future, and stuff like that. So, well, also I would say the more interactive, the better. Like anyone that wants to write a question in the chat, anyone that use the raise hand option in Zoom, like the more interactive, the better. The more that this becomes a dialogue, the better. The more that this is useful for you guys, the better. Absolutely. So, well, and I would say then I will introduce you to our guest. So, Brea Balden from SmartLoCk. And well, if you want to say a few lines about you and about SmartLoCk, that would be great.
Yeah. Thanks, first of all, for having us here today. It's a nice opportunity to meet you all and also to present you a little bit our company. SmartLoCk is a startup based in northern Germany. We digitize international supply chains with innovative tools like IoT monitoring devices and data. And we use this then to execute direct payments and payment trigger events for exporters and importers in international trade, trying to move from documentary processes that we have now in the banking sector to a more innovative approach. I'm one of three founders and the managing director of the company. And yes, we are working together with Jaime and his team since August last year. And we are very happy with the cooperation. And yeah, I'm very happy here to share our experience over prior fundraising rounds and also what we are doing right now. And I'm happy to take your questions and share our insights.
Perfect. Thank you very much, Brea. And we also have Gonzalo from Wayra. If you can introduce yourself and Wayra.
Sure thing. Thanks, Jaime. Yeah, I'm the head of investments in the DACH region from Wayra. Wayra is the corporate venture capital from Telefónica Group. You may heard about it. We have the brand Movistar in Spain, O2 in Germany, and VMO2 in UK, as well as Vivo in Brazil. We also have some relevant presence in the rest of LATAM. But yeah, our four main hubs are Brazil, Spain, UK, and Germany. We basically, the difference with us and other CVCs, we tend to think that is that we've been doing this for 13 years. So we went through changes of all the managerial stuff at all levels, even now with Payete and Marmutra. So we will remain, like that's the thing. And that's the difference of between us, I think, and another CVC. Normally you never know, right? But I would say that we will remain. And we do checks from, in our case, from 200K to 5 million, roughly it varies, right? But more or less. And let's say that we have in our head one small check that goes to companies pre-series A, that we will go up to 350, and then another big check that will go up to 5 million from Series A and Series B. We are normally a following investor, therefore we never lead. That's why I think that our value proposal is super clear, in the sense that when I talk to startups or to other investors, and around is very competitive, we are now in two processes actually, is that look, our added value is very clear. We will try to be there without making any noise. We're smart money, we try to do things fast, and we will give you a devoted team of people that will be there just to make sure that you generate revenue with Telefónica. And Telefónica is a very difficult client to work with. So it's like,
I agree.
yes. So expectation is clear, first of all. But second, we at least have that team that is ready and incentivized actually to work only related to the revenues of the startup. Not too more margin for Telefónica, not too more revenue for Telefónica, but to generate revenue for our startups. And that's basically what we say. So look, it's like, we do everything that a VC does, and on top, we have this specialized team that will help you to connect with Telefónica. Yeah, we've invested in more than 1,000 companies. We have around 250 million assets under management right now. And we also invest in funds of funds. So in third-party funds, like the most famous one probably that you could know is Leadwin, managed by K Fund. We put around 30% of the total amount, so between 70 to 80 million in there. But yeah, as I said, what I care about is the direct investments in the DACH region, and that's it.
Perfect. Thank you very much. So going back to Brea, if I'm not wrong, I heard IoT, but nothing about artificial intelligence, nothing on AI. Like you are the only startup I've talked to in 2 years that didn't mention AI.
Yeah, of course, AI is embedded in the whole business model, but it's I mean, it's a buzzword right now, and everybody's using AI, but like a couple of years ago, blockchain was a buzzword. For us, it's not it's not the technology that is important, it's the value proposition that we offer our customers. And we are technology agnostic, let's say. We use that technology that brings the best value. And we will not just develop something because AI is hip or blockchain is hip. We will use blockchain when it is needed, or AI where it brings an advantage for us or for our customers.
Great. Makes a lot of sense. Absolutely. It's just that now it's like, okay, but like that must be like half of the elevator pitch. So that's great. In fact, by the way, and to cover that already at the beginning, because it's an obligatory topic now. But Gonzalo, I guess you guys are seeing like what percentage of startups would you say are like developing AI and truly like developing new AI? Slash using AI slash unrelated now.
Yeah, I can actually elaborate a little bit also on what Brita was saying before and regarding to your question. So to put in context, I would say that 75% of the decks we have, they will have the AI word at the beginning. 70 to 80%, I would say. So 2, 3 out of 10 they won't, but the rest they will. And the thing is that, of course, at some point you could have some AI in whatever you do, right? You can you could even say that the predictive text when you type is AI if you want.
Yes.
So yeah, it doesn't matter how much you want to push it. But beyond that, the difficulty and the issue is, so if you go to back to the numbers from 2021, for example, the last frenzy that we've lived, more than 70% of the companies that were unicorns in 2021, they didn't manage to raise a round or they had to do a down round. So more than 70% in 2021. So
that didn't raise after 2021, you said?
After 2021, yes. So they managed to get the valuation and then goodbye. That was it. So my fear now as an investor related to AI is I see a lot of good deals and even with great teams, of course, quite high rounds, but I'm like, and I'm sharing this because I'm also having this struggle right now with 2 companies. Great deal, great traction, great team, great co-investors. And I'm like, is the valuation too high just because of the AI? They're of course in the space of AI and agents, right? And I don't have the fear of missing out because I think that the bubble at some point will burst. But it's like, dude, despite of this, if they would be doing these numbers in any other sector, probably they would have similar metrics, but a bit less valuation probably. So it's like the difficulty for an investor that is not specialized in AI, as is our case, is how do we manage to signal the right ones? Because normally before it was traction and team, but now you have the traction and team. So you tend to challenge yourself as well. And you're like, wait. But maybe this is a revolution that will stay. But then you look back and you see what happened. And Brita was mentioning blockchain, and we could mention even B2B SaaS, and we could mention even back in the day, like even crypto, and say, well, historically, the stats are against this, right? So it's like, so it's a challenge that we have to face every day. So of course we try to talk to experts. For example, in Telefónica, we have the chance to have a wide network in Telefónica and people that specialize in AI for the whole life to try to like, okay, let's get this technical DD to try to get the information from there. But it's so difficult to maintain this balance between not staying completely out just in case and manage to get the fair valuation of the deal. And I realized that I don't know if I answered your question, by the way, and I've been talking for
Well, I got the point. Well, you started answering the question and then you went in a very interesting reflection. In fact, on that, I have 2 stories that I will mention the story, but not the sinner, like we say in Spanish, like the sin, but not the sinner. I was seeing the performance of a famous VC, of the startups in a famous VC. And then you could see that some of them were going like really great. Like you see that the startup is going amazing, like since several years ago. And then some of them not so well. But that did not correlate with the investment case for the VC. Like in some of these, the VC wasn't making that much money, and in some of these they were, because of the valuation. In the end, it's like, okay, fine, like this company may be amazing, but if you started at a stupidly high valuation and now you are comparing the current valuation with more rational benchmarks, or with even with public market benchmarks, then it's like, okay, maybe the stake in this startup that is going amazing, if I bought it for too high, then I'm not making much money. So that on the VC side. And then on the other side, on a startup, very recently I had a call with a client that they were like, we want to raise 7 million, but the company is doing great. And in our business plan, we don't need 7 million, like at all. Like we're going to be generating cash. And, so, and he was like, I believe the business plan, but like, how can I justify to investors that I want to raise more? Because, and I was like, okay, but why do you want to raise more? And he was like, I can justify a higher valuation. And I was like, this is not always good, because then you may join the 70% startup club that raised around a very high valuation and then didn't raise another one when they needed. So on this, I think there's a back to basics, and like people trying to play, like this webinar is about startup funding. I think many times people try to play the startup or the VC game, when in the end it's like, it's a back to basics. It's like, how do you think your company is worth? How much are you willing to give up? And how much money do you really need? And if the last round was 4 million and now you need 4 million, that's totally fine. It's like, how much do you need to get to the next stage? And whatever. So yeah, these type of games usually end badly, and you regret it a couple of years down the road. So perfect. To talk about funding in general. So Brita, can you tell us, well, first of all, like how you came up with SmartLoCk and the decision of, I'm gonna be a VC-backed startup versus other type of business, like the one I have, and how it has been the funding history up to today.
Well, the idea came up over many years. It's a development of the first startup I founded a long time ago, which I exited in 2015, and then continued the whole idea over Horizon 2020 projects. And at one point, it was clear that if you really want to do something that makes a difference, you need to have a viable business model that is also backed by real money and not by funded money, because otherwise you really get a little bit too well supported, let's say. And so for us, it was clear for us three founders that we want to move from the R&D supported environment to the funding and VC environment. The other thing is we have an international business model, which is international trade. So we have an international team from day one. And in order to be able to support this, it was clear that we will need to have private investment and also the flexibility and the network that private investment can bring if you are able to generate a network also from the investment side that is international. And this is where we're heading to. And so we started very, very small with a very small accelerator fund here in Northern Germany, over 30,000 K, where we did the first validations with some pilot customers, and then got money from business angels here from the network, a small bank that is investing here in Northern Germany in startups, also backed by the Northern German government. And so we slowly increased this, and using this money to improve validation, to get closer to the product market fit, and to make sure that we don't invest money for something that is not needed. So we really started very small, and we are growing, the same way. And then last year we closed our first qualifying investment round together with Hightech Gründerfonds and co-investor VC from Greece. So first international cooperation. And now we are moving into that direction, that we use this money to increase our international footprint, Dubai, India, Latin America, working also with you is a great opportunity in the Spanish-speaking environment, and so we try to use this network effect into that direction. We're planning our next real qualifying investment round for Q1 2026, and right now we have a small seed plus, which is, it's just like something that we were able to get as a support from our lead investors, our investment round last year, that we are allowed in this round to raise another 350 to 400,000 euros. And this is what we are doing now in a, if possible, as admin less burden process as possible, because being a German startup, raising money or closing an investment round is very admin burden. And this is something that really took a lot of our resources last year and defocused us from doing our job. And we try to learn from this and try to use new tools and increase our runway, manage our cash flow, and then have a real good investment round next year again.
See, by the way, now that you mentioned that it removes focus on the business, because the process is pretty painful, and in fact now I want to deep dive on this with you, that many times with clients we see that like the revenue was doing this, then it was flat, and then continued raising, and that's when they were fundraising.
Exactly.
It's like literally you have the management team focused on something else, and you can track the focus on the business in the growth. And by the way, you mentioned like what in this regard, like what are these challenges like in the very first round of this 30K, I think you mentioned, and then like with the HTGF round, what were unexpected challenges? What was the most difficult part? What was the part that you didn't expect that you would need to defend as much? What were like, the most difficult part on that?
It was exactly what Gonzalo said just before, that we were just after hype, fintech, you know, and all the valuations of the investors were, I mean, they lost really rounds with the investment they did before we were fundraising. So it was challenging because everybody was afraid to have too high valuations, and it took much longer to convince investors than we ultimately or originally estimated to make it happen. And okay, we finished and we finalized, but it was really challenging because of this volatility of the market. And there you see that there are a lot of not really logical decision making, is a lot of emotions in there, and from both sides, of course. And for us who are founders, and we are trying to concentrate on the market and on the customers, to follow up this volatility in the market is very difficult. And that's why we are very happy to have a team like yours to help us, you know, getting these vibes from the market now also for us, because like you said, either you cannot concentrate on both. You need to have a focus. And what we are trying right now, we focus on scaling, on making sure that that we qualify and we graduate for the next funding round, getting the KPIs ticked. If we do at the same time, we do additional fundraising, we will do self-focus. And this is what we try to avoid. So we are very spending conscious, making sure that we don't jeopardize our runway, and make sure that we validate every 4 weeks together also with our investors if we're on the right track. So to be honest, right now, I don't even know what the market looks like, because I'm not in the mood. I'm in the mood to get customers and to to meet those milestones that we need to meet. This is what I'm doing right now.
Perfect. On that then, I'll ask Gonzalo. So first, well, in general, like before the current market, like what would you say that are the errors of like on founders, like when they are fundraising, they talk to you and you're like, okay, you shouldn't have said that. It's more like when do they overcomplicate themselves? Where do they undercomplicate themselves? Like maybe they give too much importance to one part, maybe they give too little importance to another part. What would you say are the typical mistakes?
Yeah, I will answer that, but then don't let me forget that I want to ask Brita about the rounds that they
Sure.
did, why they chose the investors that they choose and how it was, because I think it's an interesting topic, maybe also for others. So typical mistakes. First of all, there's something that is very difficult to convey in a message, that is just the feeling that you give to others, your vibe, your energy, your storytelling ability. I think that's super important. And it's a very soft skill that is difficult to point out. Is like, should you have your mouth like that now? Should you have your fist in here, or should you have it like that, or should you have the angle in here? You don't know what that is. You don't really know what that is, but it's there, and you see it especially in the storytelling. Like, how do you find the problem that you're trying to solve, and how are you doing to solve it properly, and what makes you stand out in the crowd? So what's the thing that you know that the others don't, and why did you start in all of this very complicated race that you're starting if you're in VC? So that must be clear and easy. And it doesn't matter if you're doing info ops, B2C, or IoT. You must be good enough to be able to communicate your company to everyone. And if you're good at that, that's a huge check that many founders fail. Many of them, especially technical founders. Which is a shame, because I'm in the board of two companies, for example, that they have a technical team as founding team, very like excellent, like not just good, the excellent. And the problem is that they don't manage to sell good enough, and they don't close the deals because they lack this part of, no, the product will speak for itself. No. Yeah, I guess, of course, someone could put a counter argument of this, of course, and I'm sure there would be products. I'm thinking of Synthesia, for example. So if you hear the CEO from Synthesia talk about the product, they said, we had no idea. We just like the technology, and we were very geeks, and we would just wanted to play with it. Yes, you will have that case. It's a counterexample. Another red flag or something, like it's a kind of a mistake. It's try to pump your financials, or try to pump your projections in the first meeting. So normally we've done investments that we've been following the company, for example, for 8 months. If you show me that you're going to be in 2 million ARR in November 2025, in November 2025, I'm going to remember that, because that's my job. So I will remember. So if in November 2025, you're still in 1 million ARR, I'm going to think either you're underperforming or either you're a really bad planner. Both are bad. So try to impress the investors in the first meeting, showing some crazy numbers without really being careful. Huge problem as well. Yeah, I will stay here. I will give you these two so far.
Perfect. On that, two comments before you get to ask Brea what he said about the investors. Well, first of all, on the soft skills, on the communication, I always say that there's one part that is fake and one part that is real. Like the fake one is that if you are communicating something amazing to me in a bad way, maybe I'm not getting how amazing it is already. This I call it the fake one, because you can put the blame on me or on you, but it's happening, and that's bad already. But the second that is true is that usually the founders for a very long time, and of course it does depend on the product, but they have to sell, like you said. So it's like, if this guy is like getting me bored with a wonderful product, like maybe it's getting bored a guy that is analyzing 100 proposals that day and has 8 calls back to back, so and that's not good. And then on the projections, we obviously, part of our job is to very early stage startups, we build their first financial model. I mean, even like super early, like day one, or not so early. And many times we say that, especially when they are very early, it's an exercise where they are not gonna gain many points, although they may lose many points. And it's true that, like, I tell them, nobody really believes these figures. I mean, again, it depends on the stage of the startup, but like long term, like 4 years from now, in a startup that is on day one, like no one really believes it. But if you say $1 billion in revenue, I don't know. It looks pretty, like, I'm gonna judge you. If you say that in 10 years you're gonna have only 200,000, I'm gonna judge you too. If there's any mistake on any formula or anything like not well calculated, or if you didn't count on churn or you didn't count on something obvious, I'm gonna judge you. Besides, like, if it's well structured, if it takes into account normal benchmarks of the market, if for every question I ask you, you have an answer, that's a good sign. But yeah, many people like try to be like, okay, or try to make reality follow the Excel. They are like, these numbers need to look better. So what if I put 10 new customers per month rather than 2? Like, okay, now everything looks much better.
Yeah. And because of this, the impact of the founders that are very diligent with this and they outperform their own estimations is huge.
Yes.
Huge.
Every year with all of our clients, but Brea, of course, but all of our clients, we have the conversation for the first board meeting on like, this is the plan for the year. And we tell them like, put the lowest figure as possible that they may accept. Like, make the first board meeting of the year a fight on how low your objective is. And then we have all the time in the world to make it better, rather than trying to say this year we're gonna make 20 million when then it's more difficult. It's all about psychology in the end. I'm very interested in what you were gonna ask Brea about the investors, by the way, and her funding history.
Yeah, so my question to you was, when you were doing this more qualified round, I will skip maybe the beginning, because I think that at the beginning, especially what you mentioned about yourself and the company, so I'm focused on my clients. I don't care about the market. I'm focused on my client. I'm focused on my product. So at the beginning, I guess, yes, people you knew or that they were around in the field, etc. But when you already did this, as you call it, this qualified round with HTGF, when you did that round, why did you selected them, and why not going to another top tier fund from Germany? Or what was the selection process on your end to arrive there?
To be honest, the selection process was not as structured as it should have been. However, we have a very difficult business model. We are a mixture between supply chain logistics, innovation startup, and a fintech. So if you go to German based VCs, there are not many who are able to get the innovation of combining logistics innovation with fintech. Either you have VCs that are in this stage of a very early stage, like seed round, pre-seed seed round, that are only investing into logistics, or you have fintechs, okay? The logistics guy will not understand that the innovation or the disruption is combining this, and the fintech guys, they are not going to understand what logistics has to do with finance or with payment. So you need to find somebody who is able to combine these two things. And with our investment manager at HTGF, we were happy to find a person who was able to understand. Because really, the other guys we were talking to, it was very difficult. They either said, okay, we invest in fintechs and we don't understand the logistics and we don't know what it is. We cannot judge about it. We don't have the expertise in our team. And the other side was on the other side. So we needed a generic investor who has a lot of background and a lot of investments already, a long history, and also the ability to take a risk to do something disruptive in Germany, which is not very common in Germany. You know, normally you have small innovations in a certain field and there you invest. And our business model is risky and it's disruptive. with which goes together with this, the unpredictability, the change management that needs to be done in the market, finding the right early adapters and so on. And the same thing we had in communicating with German VCs. In Greece, this was a little bit easier because there the environment knows me, because this is where I had my first fin or in startup. So they knew me a little bit better and knew what I was able to do. But in Germany, I was a white piece of paper, so it was challenging. And with Martin from HGF, we were very, very lucky to find a person to get this sense, let's say. I don't know if I was able to answer your.
Yeah, you did. You basically need someone who understands your product, and you found that in HTGF with one specific version. So it was a mix between the fund being able to deal with mixed, let's say, fields, and especially Martin being able to understand what your value proposal is.
Yes.
Yeah. Nice.
And also to have the network behind him to validate from different points of views with his limited partners our value proposition, you know, because you cannot expect that any investment manager is able to understand all business model that are some crazy people as us are bringing up in our mind to see if this is something that is doable or not. So, and I think that's how we ended up with HGF. And we are very happy with them, by the way.
Understood.
That's right. In fact, I wanted to ask you, Brea, about that, because I mean, I just Googled it very quickly to see if I found it, and I found slightly outdated data. But still, it says over the period 2009 to 2015, HTGF market share of more than 50% of all seed investments in Germany among institutional venture capital. Like, to me, it's like also comparing to my home market that is Spain. It's pretty crazy that like a fund has over 50% of the market share of seed investments. I guess now probably it's less due to more competition, but how does that combine with like active portfolio management and active support?
Well, I can just judge about our investment manager, right? And whenever we need support, I think he's there, you know. And we are right. Look, we are not a founding team that started right from university. We are a seasoned team with people who have at least 25 to 30 years of experience in their field, with already experience in startup in founding companies. So it's different, I think, to get support in the seed phase if you don't have this experience yet. And what we need right now, we get validation, we get discussions with possible customers, we get the networking that is needed, we get the support. And so I think the way HGF was organized and the way they have, I don't know how many investment managers, and they are very, very dedicated and very specialized also in what they're doing, you know. So with this organizational structure of HGF, I think they're doing a great job, at least the way I see it. On the other hand, I don't have a lot to compare, right? So I will tell you after the next qualified investment round, when hopefully we are going to get additional investors from not Germany, and probably also lead investors which are not German, because we want to have this international footprint. And then I can tell you if there is a development or a change or something like this. So I'm probably you, with all your customers that you have, Jaime, are much better positioned to judge about this than I am, because you have so many investors in your startups. I have only two VCs and a lot of business angels, let's say, which are pooled.
It's true that what we end up seeing is that it depends not so much on the fund, but on the people. Like we can have very different feedback about a fund because this guy has this partner and this guy has this other partner. Whereas you usually don't get different feedback about this partner or about this partner, you know. So it's more like a relationship person. I mean, it's true, even if it's about people, two people can have different opinions on one person, of course. But like, then we see that like people think about the VC and the reputation of the VC, because obviously in the process of fundraising, you know, your CRM is split by VCs, not by partners. But in the end, the relationship afterwards, that many times is 8 years, it's the person, you know, and the one that you're gonna talk probably like every week and stuff like that.
Exactly. So you need to have a good match because, you know, this is like, it's maybe not as far as getting married, but you need to have a good communication line and trustful communication possibility, and also be able to talk about difficult subjects, you know, and not only, you need to have somebody where you can really talk openly, and there we are very happy with Martin. We have this, which is great.
There's always this joke that they say that marriages has an average of, maybe it was in US, by the way, the data, but it was like 80 years or something like that, and an average venture capital like more than 10. So
Exactly.
Sure.
Okay, I'm married much longer than only 8 years, just, you know, also because of my age. But I think this consistency and this trust relationship is very important. And it has to do also with the whole culture of the team and the company, and our culture fits to this continuity and reliability and trust relationship, because our motto of SmartLoCk is delivering trust to international trade for exporters and importers. So it's not only a slogan, it's something that we are really trying to live for all our stakeholders.
Yeah.
So
Jaime, excuse me, go
no,
ahead.
go ahead.
I may have a question for you related to the different funds, etc. It just relates to the fact that I've been thinking and discussing with some people these days lately in last weeks, what types of funds there are, and I'm not talking about fields or scope or ticket. I'm talking more in the sense of lead investors, following investors like CVCs, etc. What do they bring to the table and what not? So I will start then first to give you a little bit of an idea of what I'm looking in your answer, what I'm looking for in an answer, and then you let me know. So from my perspective, there are either you have the funds that will have an investment thesis that is clear, and then they will lead the round. They will be the magnet for everyone else. So in the case of Brita, it would be HTGF, right? So if people around, they know Martin, they know HTGF, and Martin is also well connected in the next round for SmartLoCk, it won't be only Brita's job, but also HTGF, bringing in new partners, etc. And the anchor investor that will promote that to happen is HTGF, because this is our investment. We want to invest in the intersection between supply chain and fintech, and this is our winner in this sector, right? We invest because X, Y, and Z. That's one type. Then you have the follower type. That could be a little bit more our case. In the case of Wayra, that even we have our own thesis, is like we cannot lead. Therefore, I need someone to lead and to do that work, and I need to trust that person and that fund to be able to follow that. And then I will add my value. What's my value? What I said before, we have this team that is super specialized in Telefónica. And then, of course, you may like to have Wayra in your cap table and Telefónica because it's a big name, etc., etc. We have some other stuff. But then you have the third type of funds that is like, of course, I won't mention any names in here, but it's like, I don't have a specific clear thesis. And even I can put some examples. We are founders and we know what we do. We invest in B2B SaaS, and because we do. So this is very common, right? And therefore, sometimes they don't manage to get to the top hot deals, but it doesn't matter that they bring the best returns, but it's like they're just in a second tier trying to invest the money, trying to deploy the capital, right? The ones that are adding most value are the first, the lead investors who are the magnets. Then the seconds who add specific smart money for some particular case. And then you have a lot of people that will add probably no value, but they will add the money. And probably if you have a good investment manager, they will follow and they will understand and they will help you. Do you see it from your perspective, because you see many ways and you're not particularly involved? Do you see that way or do you see it differently?
I see. I had never thought of this category. I see like you have it thought. I think like you have thought of this in the past and you have like the categories. I had never thought like very clearly, but I can relate. Like I would say that like the founder is not always looking for the same things in general. And even the founder can be not looking for the same things in the same invest or on different investors. For example, I know one case of a client of us that one of the VCs, not leaders in the last round, they blocked 1 hour per week with the founder to have a call and to say, how can we help you with? What can we help you with? And then he told me that he was tempted to say like, okay, I'm blocking this hour because I have a lot of work during the week, you know. And this founder was extremely happy with the VC on board, but it was like, okay, thank you guys. Like, okay, you have your part. We shook hands, you know, and I hope I can give you profit and thank you very much for the money in exchange of shares. And everyone was happy. It's like, and he told me like, if I invest in Santander, they don't expect me from or in Telefónica or in Deutsche Bank or whatever. They don't expect me to call them and say, you know what, like I think that we should, or to bring them clients. It was like, no man, I'm giving you shares. So I think that part, like I think VCs may be like afraid to play this part, but many founders can be happy with that. At the same time, and I'm thinking also of this founder, he had developed very deep personal connection with a VC from the very first round, and he kept it forever. And probably that VC didn't know much about Series C, huge deals, internationalization, whatever. But this guy had the personal connection and the trust. And this guy, like he called him every week for 5 years, you know. So I think on that, this active, not active role is, again, like maybe the founder is not looking for the same in all of them, and maybe not all of them should try to play the same role. And also, something I've seen as well is many board meetings where there could be only one guy, I mean, two guys, like the CEO and the last lead investor. Because everyone else will, like the CEO will bring a topic, the other VCs will kind of agree but not get it in too much context. The last lead investor agrees but adds something else, and then the others say like, yeah, that's right. Yeah, I've seen that many times. I'm sorry, like to be a bit harsh. I've seen that too, and many times it's like, okay, guys, like again, it's not bad in my opinion to be a silent investor like I am in the stock market, you know, but then let's assign roles properly, because the rest is noise. The rest is a friction. The rest is valuable time that neither of us is using. So I don't know. Maybe it's a little pessimistic view, but I don't know. I can see
I
that.
think so. Like if there was another data that said, I don't know if I'm getting it wrong now, so please don't take my word for granted, but I think only 30% of the funds worldwide return the money to investors in the last, I don't know how many years.
What percentage you said?
30. So if we take that into account, these roles make sense, because then there are a lot of people who is deploying money without knowing why. And that's a problem. It's not a problem for us. It's a problem for the LPs that are putting the money there, right? But
Sure.
it is a problem of the market. The market should be more mature.
Ultimately, it's also a problem for you.
Yes, yes.
And it's a problem for everybody, because if there is no return of investment, then it's a problem for everybody.
Yeah.
But I think I really agree with what Jaime said, that we have totally different roles in our board meeting. Our pool leader is the most tough guy. You know, he's the next banker. He is really tough, and he brings all the critical subjects up. And the others are more supportive. So everybody's playing a different role, and I think this is good. And because, you know, the diversity brings also in the investor group brings the value, the different backgrounds they have, the different views they have on international trade, on all this very complicated business model that we have. And so I think we have also silent investors who never ask anything and they just sign all the resolution. There is never a question. That's it. This is also what we have. This is also nice, you know. Let's work.
Perfect. Great. Okay, moving a bit on the current situation now to Gonzalo. Two comparisons, because you have been an investor in Spain and in Germany. So comparison on the markets, and now 2024 to 2025, or past versus future, that you could also from like general analysis and advice as well.
Disclaimer, every investor will have their own view, right, about the market and about the different countries. So the difference between Germany and Spain, to go for the first one, Germany is way bigger. In Germany, you not only have Germany, you have Switzerland, you have Austria, you have at least 3 countries that are bringing people with money to the table to buy your stuff. And that applies to B2C and B2B. Therefore, the market is richer, bigger, and you will find way more funds than in Spain. This tier 2 that I was referring before, actually in Germany is a bit an unfair comparison, because in Germany there is true that there is a tier 2 funds layer that they do the job. They can be more or less successful, but they do the job. Even you have huge family offices, also in Switzerland specifically, but also in Germany, that they're very good doing investments in seed, for example. This is more difficult to find in Spain. Maybe because our tendency to buy real estate, I don't know if that's the case, but the money, for example, I'll put you a clear example. Motzler Ventures from Switzerland. It's a family office, a big one, that they invested in Otto 1, Otto 1. They invested in Adyen. They invested, great companies. They invested in seed. So it's a family office. So their money, 3 people, especially the lady, Sylvie. So they will allocate 40% of the total net worth, to such a risky asset as startup. You name me any family office in Spain who will do this. Difficult. Probably there will be. I'm sure, like Caviedes, for sure.
I was thinking that. I could argue Caviedes.
Yes, you see, we can already know who that person be. In Switzerland or Germany, that you cannot. There are more people who's willing to do that. There are more money in the market. So yeah, that's the first, the biggest difference. More money, more availability due to a bigger market. Well, another small note. Germany, if you want to do or develop something related to Industry 4.0, or Brea can prove me wrong, but something more in the industrial side of things, I feel that the German companies are more keen to invest in these kind of things than the Spanish ecosystem, that is a bit more, it's not that specialized in industry, so it costs more for the startups to grow. And I'm thinking of some startups now that even you're working with some of them, but I won't mention just in case. And then the second question was about 2024 and 2025.
Past and future, yeah.
Past and future. So yeah, basically, I think we're recovering from what we were. We were in a very tough situation, and by we, I especially mean startups, actually, not really VCs, because the VCs did the loading and they have the dry powder. And if you see the stats, there are still a lot of billions to be allocated in Europe that have not been allocated yet, and the money is still piling up because the LPs had the money. So I think and I hope that some good years will come, despite of what happens with AI that will cope the highlights of the press and everything. I can envision like an industry that in the next, from here to the next 5 years, it could be great. We could get to record heights, and we got out of a moment where nobody wanted to raise because it was very difficult and the valuations were pushed down. It seems that little by little that's fading away a little bit. We see cases like Wish acquired for 32 billion. We see cases like Lovable growing 2 million ARR every week. We see cases of hope also for investors. So I think this kind of will fuel a way better like landscape for startups to get funded.
Not as crazy as 2021 or 22, I guess, but
No, I think it's too close yet to forget.
I think that does make sense. Perfect. By the way, Brea, on funding alternatives, have you guys explored it so far? Are you guys exploring? Because, I mean, we do see from our point of view, many new opportunities in the market that didn't exist 5 or definitely 10 years ago or something like that, like revenue-based funding or banks being more prone to give money to startups. Have you guys interacted with any sources of other sources of funding?
For the time being, I think this is too early for us. Of course, we are starting to cooperate now with banks. So as cooperation partners in with our business model, let's say. But for the time being, we are not. It's too early for us to move to the lending side of the fundraising. But still, I think after the next funding round, this is definitely a possibility. What we have right now from one of our pre-seed investors, we have a silent partnership, which is something like a long-term loan that we are getting with very good conditions. But to go to a normal bank or to go to revenue-based fund lending, we are not there yet. What we're doing right now, we use a blockchain-based tokenized tool, it's called, where we avoid all this administration burden for going to the notary and so on. But this is not something for a whole round. This is something just like we do now, like this little bit that we're doing, which they will then be converted in the qualifying investment round, like convertible loan agreements, and next year. And this is where we are right now. But I think this, for the time being, we are still very much in equity-based fundraising. What we're doing, of course, where it fits, we are applying for investment grants. We have one for our subsidiary in Greece, which is a good number of 400K. And if there is something that is coming up now for ESA or something like that that fits to our business model, of course, we are also leveraging on that. But this is where we focus.
Perfect. So to end in a brighter note as well, or in a bright note on Gonzalo, where do you see opportunities? Because I think historically, there's an inverse correlation with money invested in venture capital and returns. So like in phases that like VCs have been like more worried or like less money on VC, they have had better returns. And I think this also may apply by sector. And for example, personally, I think that hardware may be overlooked, at least in Spain, like 99% of the VCs say, we don't do hardware, sorry. And I always think like, if there's not much money here, maybe it's a good opportunity. Where would you say that besides the whole AI thing, where do you think there can be opportunities for good startups to thrive in the coming months, or opportunities that we will see that they skyrocket in time?
Very difficult question, because I think it also depends on the team and how do they find the problem solution, as I said at the beginning. But that being said, let's say that automation, not exactly AI, but automation applied to especially SMEs in a bigger scale, it should be something that will become a commodity in the future. Meaning, if I open a restaurant, I don't want to deal with insurance. I don't want to deal with accounting. I don't want to deal with HR topics. I don't want to deal with anything that is not my core, that is the restaurant. And this yet is not optimized. It's far from being optimized. So if you open a restaurant, a hairdresser, like a gym, whatever thing it is, you need to do 1,000 things that are not related to your business that are making you way less effective and efficient. This should change, and this is changing little by little. I can mention many companies that are doing this, but it's like also apply to B2C. If you apply to B2C, it's like the tax deductions and everything. Every time we do the tax declaration, la declaración de la renta and things like that, also in the country that it is, it's like you have a penny in it. You don't know how to do it. You want to do it right. You don't want to like con anyone, but it's like how do I do it? But now you have apps also in Germany and Spain that will help you to do that. So these kind of automations of things around that are outside of your core, I think this should be a huge.
To be honest, even in our field, like in finance and in stuff, like even with technology that already existed 10 years ago, I think we could have gone much farther. So I really think that now, especially like AI helps and natural language helps and intelligent systems help on like every time A happens, please do B. That is not necessarily a code, that is not necessarily like connecting things. This, I really hope that in 10 years, it's pretty much gone.
Yeah,
absolutely. Okay, so time is up. And well, again, thank you very much, Brea and Gonzalo. I think also you guys have been pretty transparent, which is what makes this type of content better for the audience. And well, for whoever that wants to reach us, I guess the three of us on LinkedIn are pretty active and pretty connected. Or myself, Jaime at tscfo.com. Happy to, well, for any service you guys may need, for any question you guys may have, like you guys can count on us. So again, thank you very much, Gonzalo and Brea, and everyone for attending.
Thank you, Jaime, for having us. Thanks. Nice to see you again.
Likewise.
Bye, everybody.
Bye, guys.
Bye.